Good afternoon, ladies and gentlemen. Thank you for joining the KIEP-IMF Joint Conference. The topic is 2024 World Economic Outlook, Slowed Growth Under the Use of Future Borrowed Capacity. For your reference, we have simultaneous interpretation in Korean and English. Channel 1 is for Korean and Channel 2 is for English. So first, it is my pleasure to ask Dr. Seok Lee, President of Korea Institute for International Economic Policy, to step forward and deliver his opening remarks. Please welcome him with a big round of applause.
Good afternoon, distinguished guest participant, ladies and gentlemen. First, welcome to the 13th KIEP-IMF Joint Seminar. First of all, I would like to express my sincere gratitude to all the session chairs, speakers, and the discussants for participating in this timely and important meeting. Special thanks goes to Dr. Tristan Hennick and Dr. Chris Radel from IMF for their time and dedication in making this joint conference possible. The global economy is currently undergoing rapid structural changes due to a myriad of factors, including the spread of trade protectionism, geopolitical tensions, pandemics, digital transformation, climate change, and among many others. The pandemics and regional conflict in particular have sparked the mounting inflationary pressures in the process of responding to the such so-called Palmer crisis. The debt has soared and the asset price has risen. So this is about the time to adjust to high interest rates that inflation has brought. Inflation, high interest rate, and the deleveraging are policy changes for the whole world, not just a few countries or a few individuals. According to the KIEP 2024 World Economy Outlook, the global economy is expected to grow 3% this year, followed by 2.8% next year. The United States economy is currently leading the global recovery on the backbone of a robust consumption and the labor market. Concerns about financial instability in the first half of the year has somewhat subsided, but the impact of Chinese reopening has not been as strong as expected. I would say that slower growth under constrained policy options is the key phrase for the global economy next year. As indicated earlier, we are noticing the circumstances under which the mounting debt and the burden of crisis response would hold back the economic growth of the world. There are three risk factors that could further reduce global growth. First one is naturally China risk. Second one is high debt pressure, both in the private and public sectors. And third is geopolitical risk and the resulting supply chain disruption. So the first session of today's conference, we will look at the global economy outlook in 2024 and the challenges facing the Asian region. And the second session, we will explore Chinese economy and its possible implication and impacts on the rest of the Asian region. So I hope that this conference will provide all the participants with a valuable opportunity to benefit from a wide range of perspective on hot button issues, and in particular their policy implication for paving a sound way toward a better future. So once again, I would like to thank all the participants and audience for joining us today. Thank you very much.
Thank you, Dr. Seok Lee. We will now have a brief photo session now. Please come forward. Thanks for your cooperation. Now we will continue the session 1 with the title 2024 World and Asian Economic Outlook. Dr. Seung-Hun Lee, the professor at Sungsi University, will be the moderator for this session. Please give him a big applause.
Good afternoon, everyone. Welcome to the conference, and thank you for your joining the seminar despite the cold weather. Outside is very cold today. My name is Seung-Hun Lee. I completed my job at the Bank of Korea as a senior deputy governor last August, and I'm now a professor at the Graduate School of Business at Sungsi University. It is my honor to chair this first session. Today, we'll delve into KIEP's global economic outlook and the IMF's economic focus for the Asia region. Given the current economic climate, these presentations are very especially relevant and significant. As you all know, the global economy continues to grapple with high inflation, and after the pandemic, this year we've observed disinflation trend in various countries, including the United States and Korea and the other countries. However, significant uncertainties persist. Major central banks are adopting a higher for longer stance. And recently, the long-term U.S. Treasury bond, 10-year bonds, briefly exceeded 5% last month. The market, though, is quickly adjusting to a potential rate cut in response to favorable inflation and labor market indicators. In Asia, Japan and China are undergoing major changes. A shift in the Bank of Japan's YCC is expected, and China is facing a significant challenge due to non-performing loans and debts in its real estate sector. In this context, the economic focus and analysis from KIEP and the IMF's Asia and Pacific Department will provide crucial insights into the economic outlook for the next year amidst the high level of uncertainty. Now, let me now introduce today's speakers. Our first presentation, 2024 KIEP World Economic Outlook, will be delivered by Dr. Sang-Ha Yoon, the head of the International Macroeconomics team at KIEP. He will share valuable insights into anticipated global economic trends. And the next presenter, Dr. Tristan Hennig, is an economist in the Regional Study Division at the IMF's Asia and Pacific Department. He will delve into the regional economic outlook for Asia and Pacific, challenges to sustaining growth and disinflation. Please join me in warmly welcoming Dr. Yoon and Dr. Hennig. And we'll have the first hour for the session, and each presenter will be approximately about 20 minutes, and followed by maybe a 10 to 15 minutes Q&A session. And now, Sang-Ha Yoon have the stage.
Thank you very much for your introduction. Hello, my name is Sang-Ha Yoon, the head of International Macroeconomics team at Korea Institute for International Economic Policy. Let me present the World Economic Outlook for 2024. This outlook was released about 2 weeks ago and is the result of the collaborative work of researchers at KIEP. The presentation will proceed as follows. First, I'll provide the overview of the global economy, presenting a bird's eye view. And this will include messages for the outlook for the coming year, together with some risk factors. And next, I'll discuss international financial and commodity markets, including interest rates, exchange rate, and oil prices. And following that, I'll elaborate on the outlook for some selective countries. And lastly, let me give you some brief policy implications. So if you look at the graph in 2023, the global economy will grow by 3% by our estimate. And the outlook for 2024 is going to be 2.8 next year, which is a 0.2 percentage point lower. Examining the growth forecast for 2024 by country, the United States is expected to grow by 1.5. The Eurozone is going to be 1.1, Japan by 1%, China by 4.5%, India by 6.2%, ASEAN 5 countries by 4.6%, Russia by 1%, and Brazil by 1.4%. Looking at the growth trends from 2022 to 2024, we observe an increase in growth rates in countries such as the United States, Japan, China this year, followed by a slowdown next year. For most regions, the growth rate in 2024 is projected to fall short of the growth rate in 2022. The average growth rates from 2020 to 2022, the post-COVID-19 period, are 2.4 for the world, 1.7 for the United States, 1.2 for Eurozone, minus 0.4 for Japan, 4.5 for China, sorry for many numbers, and 3.4 for India, 1.6 for ASEAN 5 countries, 0.2 for Russia, and 1.5 for Brazil. If I can summarize, it can be said that the global economy has not fully recovered its pre-pandemic growth trajectory. If we compare the 2024 outlook with the previous release, we see the blue dashed line represent the May forecast and the red solid line represent the November forecast. The global economic growth rate was revised downward from 3% in May to 2.8% in November. Factors such as the robustness of the US economy compared to the challenges faced by major European countries and limited reopening effects in China, coupled with increased uncertainty in real estate sectors, influenced this adjustment. Most regions, excluding the United States, saw a downward revision in the growth outlook for next year. Now let's look at the changes in forecast by major institutions over time. The outlook for this year's growth has improved compared to the end of last year, with concerns about high interest rates not materializing so far. However, the growth forecast for 2024, as you can see in the right-hand side, has decreased somehow due to the impact of base effect. Examining the trend of economic growth rates in major countries, we see that the United States is leading the gradual growth of the global economy as mentioned earlier. At this time, the key theme of the global economic growth presented here is in Korean, 당겨쓴 여력, 압박받는 성장, slowed growth under the use of future borrowed capacity. After the COVID-19 pandemic, the government debt has increased significantly in major countries due to policy responses. At the time, active government roles were necessary and similar policies were implemented worldwide. This was a period where considerations for high interest rates were not significant. However, the capacity pulled during that time is expected to act as a constraint in the era of high interest rates. Adapting to high interest rates will take time, and it can be achieved by adjusting consumption and investment. The growth is under pressure. 3 risk factors related to this situation are following. The first is the possibility of China entering a medium to long-run low growth path. China is exposed to various structural vulnerabilities. The real estate sector particularly highlights weaknesses in the Chinese economy. In addition to that, Factors such as an aging population, declining productivity, and deepening polarization and a decrease in foreign direct investments are potential sources of long-term growth slowdown. The second is the possibility of growth decline due to the dual effects of high debt and high interest rates. With the liquidity unleashed after the pandemic not being withdrawn yet, the era of high interest rates has begun. Although orderly deleveraging is an ideal scenario, there are difficulties in adjusting spending behaviors immediately. There is a high possibility that it will act as a downward factor for economic activity. The third is the escalation of geopolitical conflicts and the possibility of additional supply shocks. The prolonged Russia-Ukraine war, coupled with the recent Israel-Hamas conflict, may result in additional oil price shocks. While it is difficult to predict how the Israel-Hamas conflict will unfold, events in the Middle East can bring about oil shocks, and the spread to neighboring countries makes it challenging to exclude the possibility of such shocks. Let me move to the international finance and commodity markets. And moving on to the central banks of major countries, they have been raising interest rates for a while, but recently, with concerns about inflation easing and worries about economic slowdown increasing, they have been largely maintaining the current stance. Some emerging countries have even lowered policy rates. Although the exact timing of the pivot point cannot be determined yet, the crucial question remains when the United States will adjust its interest rates. This is about the long-run interest rates. The U.S. long-term government bond yields are currently at high levels due to tightening monetary policy, strong core inflation, and a positive economic situation. Unless there is a sudden change, they are expected to maintain these high levels for the time being. The decline in government bond yields is ultimately tied to the pivot point of monetary policy, the possibility of a decline in inflation, and economic slowdown. The Bank of Japan is gradually raising the upper limit of yield curve control while observing the trend of long-term interest rates. After confirming the stabilization of inflation and the start of a decline in U.S. policy rates, it may consider withdrawing accommodative monetary policy in earnest. And this chapter is about the exchange rate. The strength of the US dollar is primarily due to the better growth trajectory of the United States economy compared to other countries and the higher interest rate differential. This trend is expected to continue at least until the first half of next year. For the Korean won, it is expected to shift from a weak trend to a turnaround when US monetary policy becomes more accommodative and the Korean economy, especially the export sector, shows signs of improvement. And now regarding the oil prices, we forecast a relative high range in the average of the $80 due to supply adjustment rather than demand factors. Since OPEC Plus adjusts production to maximize its oil sales profits, there's not significant downward pressure. Factors such as increased production by U.S. shale companies, mergers and acquisitions by major oil companies, and the resumption of oil exports from Venezuela exist as downward factors, but the impact of supply reduction is considered more significant. Now let me move to the outlook for major countries. The United States is expected to grow by 1.5% in 2024, following a 2.4% growth this year. The labor market in the United States continues to show resilience beyond expectations. Based on this, private consumption expenditure is driving growth, and investments are also active. While the unemployment rate is at its lowest, the pace of employment growth is gradually slowing. But the burden of high interest rates has not materialized yet, and it is anticipated to impact economic activity gradually, leading to a slowdown in growth next year. Also, high government debt and interest burdens are expected to constrain fiscal contributions. And now, the Eurozone forecasts 1.1% growth in 2024, following a 0.5% growth this year. The aftermath of the Russia-Ukraine war has led to persistently high inflation and high interest rates, causing domestic and external economic weaknesses. The third quarter of this year showed contraction. Germany, with the highest weight, is expected to experience a contraction of minus 0.4% this year, facing difficulties primarily in manufacturing sector. The ongoing increase in underlying inflation prompts the European Central Bank to continue raising interest rates, leading banks to tighten lending standards and expanding the burdens on businesses and households. Now for Japan, Japan's growth is expected to slow down to 1% in 2024 after 1.9% growth this year. Employment conditions are improving, and the income environment, including corporate profits and household income, has also improved. The trend of increasing regular employment is contributing to employment stability. External factors such as growth in automobile exports and an increase in tourism are supporting the recovery too. However, inflation and pressure on the yen exchange rate are prompting a policy shift by the Bank of Japan, and concerns arise about the timing and method of implementing an exit strategy given the significant government debt. China is expected to grow by 4.5% in 2024, following a 5.3% growth this year. Now, despite expectations of rapid economic recovery post-reopening, macroeconomic indicators in the first half of this year did not improve as expected. Chinese government's commitment to addressing structural issues were noted in the recent government conference, but concerns about China, which is facing a slowdown, and the fragmentation of the world economy due to US-China tensions suggest the need for structural reform. Consequently, China's growth is not expected to significantly improve next year compared to the average growth since the pandemic. Now, India is forecasted to grow by 6.2% in 2024, following a 6% growth this year. India benefits from a stable financial and political environment, portraying it as the biggest beneficiary of international fragmentation. Investments in India are expanding, especially in manufacturing, as efforts to diversify global supply chains attract domestic and foreign companies. Russia expects 1% growth in 2024 after a high than expected 2.2% growth this year. Despite prolonged warfare and economic sanctions, oil and natural gas exports continue to several countries. However, the persistence of economic sanctions is expected to maintain a low growth trajectory. Russia's increasing economic dependence on China is anticipated as a result of high synchronization with China's economic situation. Lastly, Brazil. The Brazil forecast is 1.4% growth in 2024 after a significantly higher than expected 3% growth this year. Brazil, heavily influenced by the agricultural production, is experiencing a relatively favorable situation this year. However, next year's growth is expected to be hampered by investment contraction due to high interest rates. Now, let me summarize my presentations by telling you about some policy implications. The policy space is currently very limited. A framework that comprehensively considers multiple goals is also necessary. Firstly, a systematic reduction of the expanded debt should take precedence. Choosing the wrong path in monetary policy could lead to a resurgence of inflation or a respreading of debt. Finding the optimal path of monetary policy is crucial. Secondly, since the damages of the economic downturn are distributed unevenly, support for the vulnerables is essential even in a situation with limited fiscal capacity. Policy support for enhancing medium to long-term growth potential and productivity is also crucial. Lastly, regarding geopolitical conflicts and supply chain disruptions, there's a need for in-depth research on who bears how much of the cost and benefits. This information should be internalized for decision making. Thank you very much for your attention, and let me have your question after the presentation of Dr. Hennig. Thank you very much.
Thank you, Mr. Yoon, for your insightful presentation. And we have the next presenter. Henrik, it's your time. Mr. Yoon, save some time so you have enough time to go.
Okay. Good afternoon. I'm still working on my Korean, but I want to say 감사합니다 to everybody at KIEP for the invitation. It's a tremendous honor to come here today and present on the regional economic outlook for Asia and the Pacific to you. So my presentation today is based on the fall regional economic outlook, which was launched in October during the annual meetings in Marrakesh. There have been some slight updates since, and I will highlight those as we go along. Let me first outline a couple of the key messages that I will be talking about in this presentation. First, the Asia-Pacific region remains on track to deliver 2/3 of global growth this year. However, headwinds from China's slowdown and moderating domestic investment are weighing on the outlook. The risks to the outlook are a little bit more balanced than they were in April, but they are still tilted to the downside, and they include a further slowdown in China, stickier than expected inflation, tightening global financial conditions, and geoeconomic fragmentation. So policymakers in the region should prioritize tackling inflation while preserving financial stability and rebuilding their fiscal buffers while tackling structural issues. Let me now talk a little bit more about all of these, starting with recent developments. The first half of 2023 was in general quite positive for the region. Growth generally surprised to the upside in the first quarter. The second quarter presented a little bit more mixed picture. We are seeing, despite the positive performance in the first half, we are seeing growth slow down a little bit. And in addition, if we look at the decomposition, which is the chart on the left, we observe two things. First of all, large positive factor in the first half of the year was private consumption. And secondly, we're observing that investment, those are the red bars, are slowing from Q1 into Q2. So investment has emerged as a drag on growth across the region. So that raises two questions. Why has private consumption been so strong, and why is investment slowing? And I will elaborate a little bit on those in a second. But since then, we've also gotten Q3 growth numbers, which are on the right. Those have largely been in line with our forecast. So we've had some positive surprises in the Philippines, Malaysia, and notably in China. China has performed a little bit better than we had expected. Some countries, such as Vietnam, Korea, Indonesia, projections were in line with what we expected. And then we had some negative surprises in Japan, Thailand. So with that out of the way, let me return to investment and private consumption. So why is investment so weak at the moment? To answer that question, we need to look at external demand. External demand is closely linked to investment in Asia. And if we look at import demand from Asia's big trading partners, China, EU, and the US, we can see that demand coming from the EU and the US has been contracting over the past year. There was a little bit of a boost following China's reopening, but that too is now fading. And so as a result, that's the middle chart, we are seeing exports also contracting year over year, and this is particularly affecting electronics, which are very important in some countries, including Korea. So this is the recent developments, and if we go back a little bit further and we compare investment in Asia's advanced economies and emerging markets with the pre-pandemic trend, we can see, and this is the chart on the right, that investment in emerging markets is still lagging its pre-pandemic trend. So here we're looking at what investment would have been if it had continued its trend from before the pandemic. Those are the dashed lines. And what investment actually is. Those are the solid lines. And we can see here that while advanced economies have recovered their pre-pandemic trend, emerging markets have not. So there may be some scarring here that could have implications in the future as well. Moving on to private consumption. Private consumption has held up very well so far and has largely driven growth in many economies across the region. This was mostly because the reopening from the pandemic of course, led many people to return to the consumption of domestic services. So services have been doing exceptionally well, particularly in Asia's EMs. And retail sales have also grown a lot, and they are still growing. So consumers have been, going back to services and buying things in shops more than before. And this was, of course, financed in part by excess savings that households had built up during the pandemic. So in the chart on the right, we see some excess savings. And one interesting thing to point out here is that excess savings in many countries have been stable, maybe falling a little bit, but in the US, consumers have been most inclined to actually spend down the savings that they had built up. And so that has really supported growth over the last year. But then, of course, this is something that will not be able to go on forever. And we may see some slowdown in the US based on that. Financial conditions have diverged across Asia. In advanced economies, we're seeing actually quite tight conditions, while in emerging markets, financial conditions are surprisingly loose, despite monetary tightening by the region's central banks. The most salient aspect of this is 10-year sovereign yields, which are the chart in the middle. So especially in emerging markets, we have seen sovereign yields increase by very little. We did some further analysis on this, which you cannot see on the slide, but we looked into why that is, and there are three main factors that have held down 10-year sovereign yields across Asia's emerging markets. First of all, domestic liquidity remains high in many countries, partly driven by expansionary monetary policy during COVID. Second, central banks across the region continue to hold large amounts of government bonds, which they had acquired during the pandemic, and they have not unwound. And lastly, term premia are still very low. This is a global phenomenon that also translates or applies in Asia. And if we look at exchange rates as another factor, we see that while dollar strength has been a very oft-mentioned topic, if we compare the region's currencies against the Chinese yuan, we see that they have actually slightly appreciated, or many currencies across the region have slightly appreciated against the renminbi. On inflation, there's some really good news for Asia here. Inflation has been less of a problem than in other regions of the world. And inflation has also been coming down across the region over the last few months. We're seeing a little bit of a tick up in advanced economies in the last few months. That was mostly due to rising energy and food prices, particularly oil and the rice price. But, and as I will mention also later, that recent surge in those prices has now abated. And so we're likely to see that downward trend continue. This is also confirmed if we look in the right chart on if we compare year on year with sequential inflation. Even in countries where year-on-year core inflation is still high, sequential inflation is much closer to targets or maybe even below them. So we're likely to see core inflation moderating in all countries going forward. The last slide in this section will be on China. So when we published the Regional Economic Outlook, our story was that the reopening in China is losing steam. And in a sense, the reopening overall has still disappointed compared to forecasts that were made at the beginning of the year. However, conditions have somewhat stabilized over the last few months. while the real estate sector is still in the doldrums, we're seeing manufacturing activity and retail sales stabilizing. And Chinese tourism, Chinese outbound tourism, is also recovering. It is still some way off its pre-pandemic levels, but we've seen a marked improvement in 2023 so far. With that, let me turn to the outlook. Starting with the outlook for Asia as a whole, we project Asia's growth in 2023 at 4.6% and in 2024 at 4.2%. So that is the mild slowdown that I was talking about earlier. If we compare that to the rest of the world, we can see that Asia is growing much faster. And in fact, Asia is the most dynamic region in the world in terms of growth and on track to contribute 2/3 of global growth. Let me now focus on Asia's advanced economies. Growth in Australia and New Zealand is being weighed down by restrictive monetary policy stances. These countries still have sticky core inflation, and central banks have hiked policy rates to high levels, which is weighing down on domestic demand and as a result also on growth. In Korea, Taiwan province of China, and Singapore, growth this year has been weighed down by the technology cycle and the downturn in semiconductor exports and prices. But this is projected to improve as the technology cycle turns and as prices for semiconductors recover into the coming year. So we're seeing a positive dynamic here in 2024 compared to 2023. So these countries will actually buck the trend of the rest of the region's slowdown into 2024. And lastly, in Japan, we've seen strong growth this year on the back of also expansionary monetary policy. The resulting depreciation of the yen has fueled exports, particularly automotive exports, and we've also seen an influx of tourism following its reopening. These factors are all projected to subside, though, with growth next year returning to 1%. In the region's emerging markets and developing economies, growth also remains strong, projected at 5.2% for this year and 4.8% for next year. In China, at the time this report was published in October, we had projected a growth of 5% this year and 4.2% next year. Since then, there has been some additional fiscal stimulus in China, and we've also seen the real estate sector stabilize a little bit. So these numbers are likely to be revised upwards for the January update, and our current projections are at 5.4 for this year and 4.6 for next year. Growth in India remains very strong, driven by a large public capital expenditure push and resilient domestic demand, and is projected at 6.3% for both this year and next year. The ASEAN economies are also growing fairly strongly, but are in some regions, in some countries, weighed down by strict monetary or restrictive monetary policy. Asia's frontier markets, Bangladesh, Maldives, Nepal, Cambodia, are also doing quite well, with growth on average projected around the 5% mark. So let me talk a little bit more about the main revisions in this vintage compared to the last one, which was in April. We have revised up growth in the US, as the US economy has been performing way stronger than what most people expect at the start of this year. But the reopening in China has disappointed a little bit, and so at the time of the October vintage, growth in China was revised down. So we were interested in the impact of this on the rest of the region, and we did some work tailoring or calibrating these exact revisions in a simple framework and looking at their impact on the rest of the region. And what we found was that in general, that's the middle chart, these kind of revisions would have a net benefit for the region, despite the fact that they go in opposing directions. However, once we account for the split between goods and services, that benefit is expected to be much more short-lived and also lower in magnitude. Let me explain a little bit more about what I mean by the split between goods and services. Well, what has the upward revision in the US really been driven by? It has been driven by the reopening from COVID-era lockdowns, and that reopening involved a shift in consumption from goods back to services. We all remember during the pandemic when we all got locked up at home, we started consuming a lot less haircuts and a lot more technology products to have Zoom calls and so on. But now we're seeing the reversal of this effect, and consumers are going back to services and abandoning goods. So if we look at the projections for goods demand, that's the middle chart, those are actually quite sluggish. We look at the projections for services demand, those are quite dynamic. And this, of course, has implications for Asia because only the goods demand from the US and China is what essentially translates positively for the region and for the region's manufacturing and exporters. And so overall, this rotation from goods to services means that upward revisions in the US are likely less beneficial this time than they would have otherwise been. Moving on to inflation, as I mentioned, good news here. So the disinflationary path that we're projecting is very similar to what we had in April, if not slightly faster. And if we compare current projections with targets and target ranges, that's the chart in the middle, we see even in countries where current values are high, those are the red triangles, the projection for the end of 2024 is either very close or in line with central bank targets. That's the blue dots compared to the dashes. So in other words, in many countries, inflation is already back at target, and even in those where it's not, we expect it to return by the end of 2024. And that puts Asia ahead of other regions in the world. The chart on the right also shows that as output gaps close, deviation of core inflation from target will also go down. So what I want you to see here is that the dispersion of dots in 2024, so the dispersion of the red dots is much smaller than the dispersion of the blue or green dots, meaning that as output gaps close, both from above and from below, depending on the country, the deviation of core inflation from target will also recede. So the risks to the outlook, well, first of all, we have the risk of a further slowdown in China, in the near term in this case. So our analysis shows that for a 1 percentage point decline in growth in China, we would expect a 0.3 percentage point reduction in growth in the rest of the region. However, it is important to note that the impact for the region will vary depending on where the slowdown occurs in China. So depending on whether we're seeing a shock to investment, consumption, or the property sector, we may see different impact across the region. However, in general, it can be said that the countries that are most exposed are those with the highest export value added to China. Those, of course, here we have Hong Kong, Vietnam, Laos, but then also the ASEAN countries, and Korea, Singapore, Indonesia will also be affected in some way. Then we have commodity prices. We saw a little bit of a surge in oil prices and also in rice prices in September and October. Those prices have come down a little bit now, but they're still a little bit higher than what we were using at the time we made these projections. And of course, this is a risk scenario, so there remains upside risk to the outlook coming from commodity prices. And we've done some work that shows, and this is the middle chart, that particularly in emerging markets, shocks to energy and food prices can feed through to core inflation if they de-anchor inflation expectations. So this is something that monetary policymakers will have to keep in mind. And in advanced economies, on the other hand, it is the tight job markets that might prove a headache for policymakers. Financial conditions, as I mentioned, are still very loose in emerging markets, and they've recently also loosened in advanced economies a little bit with the reduction in the 10-year yield in the US. And so this is something that we could see reverse abruptly, which would present a risk for the region because shocks to external and domestic financial conditions usually are followed by a reduction in growth. So we've done some analysis. That's the chart in the middle of the impact of tighter US financial conditions, and the chart on the right is the impact of tighter domestic financial conditions. And if we think about the growth distribution for the year ahead, the chart on the very right shows you that what we call growth at risk, which is the 5th percentile or the lower end of the growth distribution, shifts downward or shifts further into negative territory by a statistically significant margin, specifically in emerging markets. Lastly, we have the medium-term slowdown in China. And we have another full session and presentation by my colleague Chris on this, so I will be very brief here and to say that we've revised down the medium-term outlook for China from the high 4s to the low 3s, which is going to have a massive impact on the region. And there are various scenarios to take into account. Friendshoring involves a reallocation of supply chains along geopolitical lines, and reshoring involves a reallocation of supply chains towards more domestic sources. So what should policymakers do in the face of this outlook and the risks connected to the outlook? Well, first of all, monetary policy. Let me start with monetary policy. If we look at the current tightening cycle compared to previous tightening cycles, we can see that the current one was much more forceful in the sense that central banks hiked by more than in previous tightening cycles, but they also came from much lower levels, right? And so the final stance that they've ended up at is actually not as tight as one might have expected. Real rates, that's the chart in the middle, are somewhat positive in advanced economies, but very close to neutral in emerging markets. And this is also translated into the stylized fact mentioned earlier that 10-year sovereign yields are actually much lower than they were in previous tightening cycles. And so what should policymakers do with this? Well, our advice here is that central banks should take a very cautious stance, a very cautious approach to easing. As inflation comes down, it is correct to reevaluate your stance, especially if growth has moderated as well. However, we've done some analysis that shows that if financial conditions are loose, the disinflationary impact of rate cuts is, the disinflationary impact of rate hikes is actually much lower than it is when conditions are tight. And this in turn also means that the sacrifice you have to make in terms of growth of keeping monetary policy tight is much lower. So in other words, you're much better off keeping conditions a little bit tighter in order to make sure that inflation is a target and that inflation expectations are anchored, just because the growth cost that you're paying to do that is much lower in the current environment. Moving on to fiscal policy. Here, of course, we have the legacy from the pandemic that in many countries, debt burdens are now much, much higher than they were before. So the left chart compares current debt burdens to fiscal revenue. And we've done some comparative analysis here comparing revenue in Asia with other countries, peer countries across the globe. And what we're seeing is that there's a gap between Asia and the rest of the world in the sense that government revenue remains much lower than in peers across the region. So this means there is scope for revenue-enhancing reforms, such as expanding tax bases and improving the revenue collection as well. Then the chart on the right shows that implicit subsidies across Asia are also fairly high, particularly in emerging markets. So those could be reformed as well. But doing that will, of course, need to ensure that safety nets are not weakened or are strengthened and the vulnerable are protected. The banking sector has fared quite well. In fact, the increase in interest rates has led to an increase in profitability in banks across the region, as deposit rates have generally not kept up with policy rates. This has been a boon for some banks, but, and there's the chart on the very right, there may be pockets of the financial system, particularly smaller banks, who might be feeling the pinch from competition with other banks a little bit more. They might see themselves forced to raise deposit rates faster than other banks, and they could get squeezed in this scenario. So policymakers will need to remain vigilant and keep an eye out for pockets of vulnerability in the financial system. And they should also use macroprudential tools to address these pockets of vulnerabilities. Let me finish with structural policies. So I'm bunching a lot of things into one slide here. But in the chart on the left, we are comparing current growth with the projection that was made before COVID. And we can see that advanced economies, those are the green line, and the US as well, have kind of recovered the level that had been predicted before the pandemic. But then emerging markets across Asia, as well as China and India, have not. So there may be some scarring from the pandemic. Then we also have inequality, which remains slightly higher in emerging Asia than it is in other emerging markets across the region. And of course, there's climate change, and the costs have really exploded, and they will continue to go up, both for mitigation and for adaptation to climate change. And so policymakers will need to keep an eye on that too. So if I summarize all of this, policymakers should maintain a sufficiently restrictive monetary policy stance until inflation is reliably within target. And they should use macroprudential tools to tackle pockets of vulnerabilities in the financial sector. On fiscal policy, consolidation should continue. And with the higher debt burdens following the pandemic, work on credible medium-term frameworks is crucial. On structural policies, we have China's medium-term slowdown, which will, and of course the associated geoeconomic fragmentation, which are challenges for policymakers, and they call for renewed mutual cooperation across the region. Lastly, policymakers will also need to work on improving digitalization and education, and work on labor market reforms and the green transition. Let me stop here and let me say thank you very, very much again for your attention and for the invitation. Thank you.
Thank you, Mr. Hennig. Both presentation is very comprehensive and give us some good insights of current economic development and also the prospects and the outlook for next year. Especially they explained about the inflationary trend and some concern over the growth, especially in Asia. We'll talk about next section in China intensively, but the Chinese issue is a very important one. And nowadays the market fluctuates a lot. The bond markets, the rates, yields is going up, down very severely. And it's also it makes some impact on the financial conditions, as Mr. Hennig said. If the market goes too much, and then it will make some impact on inflation trend kind of thing. So there are lots of things that are going on, and maybe I think you have many questions about their outlooks and presentations. So the mic is on the floor, so I expect many good, insightful questions. Yeah.
Hi, I'm Stephen Borowick. I'm a reporter for Nikkei Asia. My question is for Mr. Henning. Just in your remarks just now, you mentioned that the slowdown in China is a response to it ought to be renewed cooperation on a regional basis. So in the news this week here in Korea, there's a lot of talk about China restricting exports of graphite. And so that's, and there's a political background to those moves that we don't need to get into, but amid those kinds of scenarios where political frictions are bleeding over into things like trade and are hindering efforts towards fostering growth, is there a kind of policy approach that you think is apt in that case? Or just how do you advise governments and economists and policymakers to tackle those kinds of questions? Thank you.
So, Mr. Henning?
Yeah, thanks, Stephen. Thanks for the question. No, I think this is very important. And we've seen, so the restrictions that you mentioned, of course, not the first restrictions in this year, and not the first restrictions that we've seen come from China or in the China-US dispute over the past couple of years. So what I can say here is, the IMF doesn't really get into the politics of it here, but from an economic standpoint, it's very safe to say that all of these trade restrictions ultimately hurt everybody. And I think the session later will also illuminate a little bit more of it. We've done some analysis because there's often a story going around that some countries think they might benefit from the fragmentation that we're currently seeing. And while there might be some reallocation over the short horizon, over the long term, everybody will lose from the from the reduced growth that will come with these trade restrictions. So let me leave it there.
Okay, other questions? It's a very good opportunity to make a question to them. So yeah, here.
So thank you both for great presentations. I've got two questions to Dr. Hennig from the IMF on low income and lower middle income countries that we haven't talked about very much today. So there's high possibility that a prolonged period of high global interest rates caused by rapid monetary tightening in the advanced world will lead to debt crises in many developing countries, which have already been suffering from significant fiscal problems since the COVID-19 pandemic. So how do you assess the current debt situation, especially the government debt situation in low and lower middle income countries? And what do you think that could be done at the global level or at the level of G20, for instance, to support these vulnerable countries in the era of high global interest rates? Thank you.
Yeah, thanks for that question. No, that's a really, really important point. And one thing I didn't mention in the presentation is that we also look at the Pacific Island countries, for instance, and many of those have really suffered for much longer than others because the tourism recovery in Asia has been much slower than the tourism recovery in other parts of the world, and there are many tourism-dependent Pacific Island countries where real GDP is still below 2019 levels. So they really rely on these, the income from tourism, and they, of course, if that doesn't materialize, if that doesn't come back over the near to medium term, they will face some issues from that, of course, and the other thing is then, of course, also how long high interest rates will stick around. I think we are still seeing that despite the drop in the 10-year yield in the US, we're still very much in higher for longer world. There's been a lot of talk about, the Fed is done with raising rates and so on. But if we really look at the yield curve right now and compare it to where it was, say, in April or at the beginning of the year, it's still much, much higher. So with high interest rates sticking around, I think that, these debt issues, they will slowly come to fore more and more over the coming year or two. And as you mentioned, sort of cooperation on the G20 is extremely important to tackle those. There are also many IMF precautionary arrangements that countries can avail themselves of. So these are the avenues that we see to tackle those issues. And then, as mentioned on the slide, of course, governors can also do a lot domestically, both on the revenue and the expenditure side. As mentioned in Asia, government revenues on average lower than in peers across the region. So this is something to work on. And then, of course, the quality of expenditures can always be improved and reallocated, of course, always while making sure that, social safety nets remain strong. Let me leave it there. Thanks.
Okay, thank you. Another question? Okay, thank you.
I would like to have some question on the opinion. You mentioned about the policy, especially optimal monetary policy, pass generally to the deleveraging issue kind of thing. Well, I'm a little confusing that generally monetary policy target is like inflation or GDP gap for the simple Taylor rule like that. That means national debt should be also kind of an instrument for the monetary policy is already a question to me. And then, according to your policy recommendation, it looks like Korean government should keep the interest rate to preventing re-spreading of the debt like that kind of thing. Okay, so my question on the Dr. Yoon is the general stance of the monetary policy in the next couple of years, not only for Korea but also for, because the deleveraging is, as you mentioned, it's got like spread all over the world right now. So please.
Thank you very much for your very important question, and I totally agree with you, because your expertise about the monetary policy was much higher than my expertise. So I totally agree with you. And of course, the target of the monetary policy is about the inflation and growth, or for some countries in employment. That is true. But for now, what I think is that the higher level of debt, which is related to high interest rate, is crucial when they consider the monetary, even if that's not an explicit a monetary policy objective. So, of course, the debt problem or debt leveraging is the area of regulatory agencies, for example, but still maybe many of the central banks, as a research, they try to find a way of find the impact of monetary policy to the debt level or the deleveraging. So that's why I mentioned the monetary policy stance as a qualitative statement, not a quantitative statement. So yeah, I don't think my statement is contradictory to your question. So yeah, I can deliver that way. Yeah, thank you. Yeah.
And other questions?
Okay. Thanks for insightful presentations. I have a question to Dr. Henning. So when you were mentioning the pace of monetary policy tightening in the region, you said it's been much faster and sharper than previous episodes. But also at the same time, you showed that the real ex-ante interest rate haven't really picked up. My first question is whether this phenomenon is driven by less responsive market interest rate or sticky inflation expectation. Because if it's the latter, it might imply that undermining the effectiveness of monetary policy. And my second question is whether there is a substantial heterogeneity across countries belonging to the group, and relate to Professor Yang's question, because looking into this graph, it gives me an impression that monetary policy tightening may have not been hawkish enough to control for inflation expectations, and also probably debt, especially household debt. So I was wondering about your comments on this.
Thanks very much. Two excellent questions. So let me start with the question on monetary policy you started out with. So it's correct that the chart was showing that the current tightening cycle was much more forceful, in the sense that the difference between the stance that or the amount of basis points, let's say, if we just look at the number of basis points that central banks have hiked, right, then we see that they hiked much more than in previous cycles. But a key aspect here is that we were coming from an extremely low level, right? So during the pandemic, many countries' central banks actually loosened, right, and to levels that were historically unseen, in a sense. And so that means, despite this forceful tightening, the final level that we ended up with is actually not that tight in a sense. If we look at ex-ante rates, which you mentioned, of course, we have many factors playing into that, including expectations about inflation and also expectations about the policy rate, right? And there, it's also important to note that for a long time, markets were very, optimistic that rates would come down very, very quickly. Then for a while, everybody seemed to finally agree that we are in higher for longer, and they would stay higher for a while. Now, with the October FOMC meeting, we've gone back to, policy rates are going to decline soonish. So it goes back and forth sometimes. I think the overall point we make, which is that conditions in emerging markets are actually not that tight. I think that's still fair to say. Of course, we need to always reevaluate. But yeah, let me leave it there on that one. And then you asked about the heterogeneity on debt, right? So one thing I can say here is that, you know, debt levels across Asia are very heterogeneous, but in many countries are actually fairly reasonable and lower than in peers across the region. And if we look at households, that's true as well. In some countries, household debt is extremely low. In some countries, oh, sorry about that. I see. True.
Australia, and I'm pretty sure Japan is behaving quite differently because
Yes,
it's been
yes.
ultra low interest rate always,
yeah,
right?
yeah, yeah.
So taking it out maybe
Uh-huh.
could give us a different picture. So that's what I was wondering about.
Yeah, so we usually we try to exclude Japan when we talk about advanced economies if it's very different than the others. I think I would need to get back to you if it's excluded in that particular chart, but yeah, typically we try to exclude it whenever it's too much of an outlier, which it often is.
Okay. We have a couple of minutes. Any other question? If not, to utilize my opportunity to ask some questions. My question is, we are seeing some kind of cyclical changes after the pandemic shock, and central banks and the governments respond very severely, and then we have very big change flow of the kind of cyclical changes. So we are seeing inflation, but also we are seeing some kind of big changes. China, Japan, it's a kind of 10 decades long kind of changes. So can you say any long-term structural changes in this situation? Okay, that's my question. Both of you?
Okay, for the China or for the for Japan too. So I think I can mention something about Chinese economy. So I briefly explained what's going to happen in China. So they're experiencing some structural change, of course, as all of you know. So one thing came from U.S.-China conflict, and the other things are, for example, aging population and declining productivity, and the other thing which comes from the U.S.-China conflict is the production unit diversification around the world. So many countries are, whether that's a desirable thing or not, many countries are moving away, or they try to diversify their production unit across the world. So even South Korea tried to manage our production location around the world to earn some security by sacrificing some efficiency. In the short run, of course, that will impact a lot to South Korea and the rest of the region, of course. And in the long run, maybe we are not that heavily dependent on Chinese economy anymore. In the long, maybe in 7 years, 10 years, I don't know. But so what we are worrying about the Chinese economy is because our elasticity, growth rate elasticity, South Korea's elasticity of growth with respect to Chinese growth rate has been changing over time. So we are very tied to Chinese economy during the last 30 years. And if there is a 1 percentage point shock in China, then that could hit South Korea by, for example, 1% point in GDP growth rate or 2% point GDP growth rate negatively, maybe. But it's going to change over time, and it will change somehow by accommodating some security problems, diversification problems, and fragmentation problems too. So I think the impact, in extreme case, of course, South Korea will be hit hardest maybe. But in a moderate case, I guess the impact of Chinese structural change, that's going to happen, of course, as other emerging countries experienced during the last 30 years, as South Korea experienced too, Japan experienced too, Taiwan experienced too. So China eventually will converge to the world GDP growth rate in the medium run, and maybe in the longer run, their growth rate will be lower than the average of the GDP growth rate of the world. But at the time, the impact of the rest of the region will be lower, I hope, or lower than current situation, I guess. I can say that way, yeah. Thank you.
Any? Shortly.
Yeah, thank you. No, I completely agree with Dr. Yoon. I think with the way the pandemic has played out, you know, the fragmentation that we're seeing now with the U.S.-China relationships play out is a big change to before, and the trade restrictions that are being imposed, as I mentioned earlier, will ultimately make the rest of the region, everybody in the world, worse off. And I think another sort of structural change, perhaps, to mention from the pandemic is, of course, in labor markets. Right? I think this is maybe something that affects the advanced economies more than the emerging markets, but I would say a big part of the population has a different take on life now following COVID-19, right? And some parts of the population have, you know, removed themselves effectively from the labor market, and that has led to those markets being very tight in advanced economies. I think in emerging markets we're seeing that play out a little bit less, but in general, still an important structural change following the pandemic. Let me stop there.
Okay, it's time we conclude this session, and I see some snacks are coming in. And I'd like to extend my gratitude, Mr. Dr. Yoon and Dr. Hennig, and please join me to clap both of them. Thank you. Thank you very much.
To the end of session 1, we are now ready for a short coffee break. The next session will begin at 3:10, yeah, sorry. And we are keeping a muffler, so if you lost it, please tell me. Thank you. We will now continue session 2, which is our final session, China's changing economy and its impact. Dr. Du Yongyang, the professor of Kyunghee University, will lead us through the session. Please welcome him with a round of big applause.
Right. Good afternoon, everyone. Welcome to the second session of 13th KIEP and IMF joint conference. The keyword for the second session is China. As mentioned in the first session, the world economy and Asia are expected to face various economic shocks, demand shock or supply shocks in the coming next year. These shocks include the US monetary shock and supply chain changes and some geopolitical shock like Israel, and Palestine, issues, as well as Ukraine actually on a war right now, kind of thing. Among these kind of shock, I think there are more important shock in the region, which is China shock. In this session, we will have two outstanding speakers presenting paper on this issue. Dr. Chris Ledl from the IMF Asian Department will analyze and present the impact of Chinese long-term growth trend to the Asian region. And the second, Dr. Song-Wei An, the chief economist and the director of KIEP, will discuss the impact of Korean economy on the Chinese shock like this. I believe that this is a very interesting issue, and I think it's very important for our region as well as Korean economi. After the presentation, we have a very excellent discussion, four excellent discussion. First, Jung Dae-hee, the director of Department of Macroeconomic and Financial Policy from the KDI, will be here today. And then Kim Young-gui, of Senior Fellow of KIEP, followed by him, and then Chris will join, the discussion during the discussion time, and the last, Professor Choi Sang-yeop from the Yonsei University will join that about, our discussion kind of thing. Okay, all right. Let's start with the first, paper from the Chris Ledl. Okay, please.
Thanks very much. So let me echo Tristan's point that it's a real pleasure to be here. So thank you very much to the organizers. I will be discussing a chapter from our Regional Economic Outlook that came out in October, titled How Will Trend Growth in China Impact the Rest of Asia? My name is Chris Riddle, and this is joint work with a number of co-authors on the page here. So I'll go through three parts of the presentation. The first documents China's growing importance in the world, and in particular Asia, with a focus on China's trade links with the world and Asia, in particular the role of global value chains. Secondly, I'll talk about the IMF's revisions to our forecast for medium-term growth for China, and motivate two scenarios to discuss. One, an upside scenario to Chinese growth relative to the baseline I will present, and another, a downside scenario based on geoeconomic fragmentation. That will set up some scenarios that we analyze using a model in the third part. Okay, so let me talk a little bit about China's growing importance in the globe. Many of these facts are
are not news to you. The first chart on the left shows the share of global GDP for China, the Euro area, and the US. And you see that Chinese growth has, or the size of the Chinese economy and the global economy has really accelerated in the last 3 decades, rising from only 2.5% of global GDP at market exchange rates to close to 20% and to be the second largest economy in the world. Now, that has come along with a substantial increase in China's trade links with the rest of the world. So the middle chart here shows the increase in China's share of global trade measured as exports and imports in US dollars. That has risen from around 2% to nearly 12% in the latest data, making it one of the most heavily involved trading nations on earth. That involvement in trade has also been associated with increased innovation. Looking at R&D expenditures, China is at purchasing power parity rates. China is second only to the US. So this highlights some of the trade links, but also China's role in an increasing role in productivity. The area which we particularly want to focus on in these trade facts is China's role in global value chains. Asia is a big export. Many countries in Asia use exports as a growth engine, and many of these countries export intermediates to each other, and China has become heavily involved in this trade. So the leftmost chart shows GVC, that is global value chain, related exports. So those are defined, or it shows China's share in them. Those are defined as exports of goods that go on to become exported themselves, or goods that have been exported using foreign inputs. Right? So there's this chain of production across different countries, so these links. You see that this share for China has grown enormously in the last 2 decades. It's actually risen 5-fold. And the nature of China's involvement in global value chains has also changed. Effectively, it's moved into higher value-added areas. So initially, China's involvement has been largely in assembling the products imported from other countries. But increasingly, they have been more involved in forward linkages in global value chains. That is, China producing higher value-added components that are also exported to other countries. If you look at so this is part of China's role in the supply chain. Another way to look at this is China's role in total production. So the chart on the right shows China's share in intermediate inputs. The first part shows the share of China in total inputs. That is, how much does China's inputs matter both with foreign inputs and domestic production inputs? And you see that's risen from below 0.5% to close to 1.25% in 2 decades. It's even more extreme when you consider the situation of China competing with other foreign countries to provide inputs. There it's risen from a similar level of around 0.5% to close to 6% in the last 2 decades. So China's role in trade is large, but its role in global value chains is even more pronounced. Now, focusing on Asia in particular, trade with China has been a particularly large driver of trade integration in the region. The leftmost chart plots trade openness, exports and imports in the region, but in particular with China. And Asia, on average, has seen an increase in this ratio of 10 percentage points in the last 2 decades. So that's very marked. It's substantially larger than the rest of the world. And in some countries, such as Vietnam, it is substantially larger. And as I've highlighted already, in the case for the world, Chinese inputs have increasingly been used to further exports for other countries. So this is the red bars, which shows you the share of forward GVC exports that China has provided from the world. This is substantially larger than just thinking about China's role in trade in terms of gross exports. It is much more heavily involved in these global value chains. But these supply elements are not the only way in which China's role in the region is substantial. China also plays a significant role in demand. So there are some countries, the rightmost chart plots the share of value added embedded in China's final demand. This is effectively China's demand for goods from the rest of the region. And you see that it's very large and particularly pronounced for Korea, a significant portion of that is the trade in intermediate goods. So one way in which to think about these issues of medium-term growth empirically is to think about how fast China has grown relative to its level of development. And the way we do that in the chapter is a simple convergence regression. So this is relating growth. We have a panel of countries and we look at their growth rate and compare it with explanatory variables of the lagged per capita GDP growth rate and a control for trade openness. Now what that's saying is that countries that have lower per capita growth tend to grow faster. That's the convergence result. And what we want to look at is, so first fact, which I'll discuss more in a second, is that China has had a lot of excess growth in this sense. China's grown much faster than its level of development would predict. It's about 5.5 percentage points of growth. Now, when you have an economy that's growing really fast and you have a bunch of other economies that are integrated with it, there may be some benefits from those linkages, right? So how much has growth in other countries been enhanced in a medium-term sense by being attached to this very fast-growing nation? And the way we quantify that is we consider how much additional growth this model would predict if a country moves from the level of integration with China you see outside of Asia to the level of integration you see inside of Asia. That's what these bars plot. So the first bar shows gross trade linkages. That is, it says that growth in a country that moves from non-Asian levels of exposure to gross trade links with China to Asian levels, which is an increase, generally sees about 0.2 percentage points of growth higher from that linkage. But we see there are other measures that we've used, which is showing again the global value chains link. That's forward linkages, where China is exporting to the country. The country is exporting to China, and backward linkages, where China is an important input. China's exports are an important input to your exports. And that is even stronger. So this quantifies the role that China has played in terms of a growth engine for the region. We'll talk more about this in the next section. So here I want to outline what the IMF has done in terms of China's projections lately, which will motivate our modeling scenario, and then talk about two scenarios which we'll put into the model. So Tristan already showed this earlier. The leftmost chart shows you how the forecasts from the IMF have changed in the last 2 years. So the relevant comparison that we use in the model is the green line, that is the October 22 World Economic Outlook forecast, was for China to grow at 4.5% and roughly to stay there, right? However, in April 2023, there was a significant downgrade to the medium-term prospects for China. You see that this has gone from a kind of constant 4.5 to down to a medium-term growth rate of about 3.5%. There's been some movement. In the October WEO, there was some drop. And as Tristan highlighted, there's now been an upgrade in the short term. So 2023, China seemed to grow faster than we had previously anticipated. And there's also an upgrade in 2024. But this doesn't really change the narrative in this chapter. The main point is that there's a sharp decline in the level of Chinese growth going forward. Excuse me. So on the right, we return to this idea of how is China's growth level been relative to its level of development. So this is these convergence regression results. And what these bars show is the excess growth China has experienced relative to the average country that is the average country's level of development. So as I noted before, you see the green bars, these have been about 5.5% in the 2000s. But the projection that we are currently showing is consistent with these excess growth levels converging down to zero. So effectively, the excess growth that we've seen in China is forecast to effectively go back to what is average for the rest of the world. That is a substantial decline in growth in the region. And we will look at two scenarios around that baseline. One where there may be some helpful reforms that raise China's productivity, and a scenario around fragmentation, which would potentially lower China's growth. So on the left, we document the upside scenario. So what we have here is some data on labor productivity in China relative to the frontier, and we take the frontier to be US levels of labor productivity. So on average, China's labor productivity is only a quarter of that of the US. What that tells us is that there's still substantial room for China to grow faster. And what we will do is we will do an upside scenario, assuming that a variety of market reforms are taken. So reforms that would raise foreign competition in the country, that would increase the role of the private sector relative to state-owned enterprises, effectively a variety of market-friendly reforms that would raise the level of productivity growth. So I'll show you those results in a moment. On the right-hand side, this is much more relevant to the debate that's been happening lately, which is on the question of fragmentation. So the IMF has published a number of analyses on fragmentation. Many of them have been quite extreme scenarios where blocks of countries would stop trading entirely in different products. This scenario that we will present here is one that is a little bit more mild and maybe more realistic, and we label it for that reason de-risking. And here we show a chart that this has become increasingly a topic in the corporate sector. These are the numbers of mentions in corporate presentations of the terms reshoring and onshoring and nearshoring and friendshoring. So there's already a substantial discussion about this risk at the moment. So let me move to some of the results of our analysis on these two scenarios. So in order to analyze that, we're going to use a standard macroeconomic model, much like the ones that are used in central banks. We call it GIM, for the Globally Integrated Monetary Fiscal Model. What's nice about this model is it has a number of different blocks of countries that interact. And we've augmented it with global value chains. So this is, as I've showed you in the previous slides, a particularly important issue for China's role in trade. And what this does in this diagram, although fairly complicated, illustrates what's going on in this model. So in order to produce output, you need capital and labor, but you also need intermediate inputs, in particular GVC goods, that is, goods that have been produced as part of this global value chain of production. And some of that production will go off to other countries as GVC exports, and some of it will go into domestic production. But this creates this roundabout production chain where there are strong links and multipliers between countries. So this allows us to analyze the spillovers from these chains effectively breaking or being reduced. Okay, so firstly, let me discuss the upside scenario. So let me explain a little bit about what these numbers are showing. So these numbers are generally quite large, and one of the reasons is they show the level of GDP 15 years from now. So that's the change we're considering. So first of all, the reforms that I mentioned earlier are intended to reignite this fast convergence that we saw in previous decades in China through market-friendly reforms, and we assume that productivity grows by 1 percentage point higher for the next 15 years. And 2 times faster in global value chain sectors where there were a particularly large productivity gap. What does that mean for China itself? So that is measured on the left axis, so from 0 to 25% there. So it shows that Chinese GDP would be 21% higher in this scenario. So this is a very substantial increase in productivity. And then our area of interest here is the spillovers to the rest of Asia. That is measured on the right-hand axis that goes from 0 to 4.5. So the spillovers from to the rest of Southeast Asia, excluding the ones that we've broken out on the chart, are large. The direct trade effects are measured in the green bars. So that just shows you the impact from a larger China and larger trade flows on other countries' GDP from higher external demand. The red bars include productivity spillovers that take place because there is a degree of higher productivity embodied in these imports that are produced in a more efficient way, this GVC production. So Southeast Asia has a significant spillover of 4% on the level of GDP after 15 years. The impact on Korea is significant. As we've discussed, the trade links in Korea are deep. In countries such as the US and the Euro area, where trade links are far more moderate, the spillovers are quite moderate. Okay, so let me discuss the de-risking scenario, the downside scenario relative to the baseline, the one that is being discussed more at the moment. So there are two elements to the scenario we discuss. One is friendshoring, and this is where a country is changing the foreign inputs that it uses for production. And reshoring is where a country is switching from using foreign suppliers to domestic suppliers. Now, what we have is two blocks to think about. One is China, and one is what we will call an OECD block. That OECD block is Europe and Switzerland, Korea, and Japan and the US. So that's one block, and China is the other block. And this is the one where we see friendshoring and reshoring happening. There is a third group of countries that are non-aligned. They are not changing their production patterns in terms of where they get foreign inputs. These are the ones where they may see some benefits from short-term growth in exports. But as Tristan mentioned in his presentation, the overall effects of lower trade actually drag down on them as well. So how do we calibrate this shock? So for friendshoring, what we do is we look at input-output tables. So the flows of these trades between different countries. And we dial that back from the level we see today in 2022 all the way back to 2000. So we unravel all the integration that's been happening in the last 20 years. So for example, in the EU, foreign investment was sort of 10% of GDP, and in 2000, and it's now about 13%. So we reduced that foreign share in the reshoring scenario by 3 percentage points. So that's the shock we would do for that region. Here are the general parameters we use in the friendshoring section. So we reduce GVC and non-GVC goods by around 5 percentage points. Investment and consumption, these are much larger at 10 percentage points, and this is consistent with the calibration we see in 2000. Reshoring, which is a much more significant shock, because you're not just picking the next best foreign supplier, you are no longer able to use those suppliers, so there's a larger productivity impact. These calibrations are more mild, and these are about 2.5% for GVC and non-GVC goods and smaller for consumption. Okay, so these are the core results, which Tristan also showed. Let me discuss the friendshoring impact first. So China, the impact on China's GDP level after 15 years would be around slightly more than 6% scenario. The impact globally is lower GDP by 1.8%, but of course there's heterogeneity across countries. The impact for countries with deeper trade links such as Korea is larger, but more mild for the US and the Euro area. A reshoring scenario is more severe in terms of its spillovers. It has a similar effect for China in terms of its own economy, but the spillovers globally are 4% after 15 years, but are as large as 10% for a country like Korea with much deeper trade links with China. Okay, I think I'm probably out of time, so that will be...
All right, thank you, Chris. Next paper will be presented by Dr. An Song-bae.
Hello, I'm Song-bae An, the Chief Economist of KIEP. Today I will talk about the China shock and its spillover effect on Korean economy. This is joint work with my colleague at KIEP. So it has four sections. First, I briefly talk about some kind of the long run situation of external sector of Korea. And second part is that the China situation, what is happening in China in terms of the growth slowdown. And then I will show some empirical result using the GVAR model and on the spillover effect of the China shock to Korea and policy implication follows. So the first, basically, this is the trade surplus, well, at the custom clearance level. So the over the years was kind of after the global financial crisis at 2008, well, Korean trade surplus of Korea well increases well after that, and here well it is well topped around 2017 and 18, and after that well it slowly declines, and well recently last year it becomes negative. And here, well, when you look at some well current account balance, which is a little bit different from the trade surplus, here well we have some goods trade goods trade balance and the service trade balance, and their primary income and secondary income and the things. And what you can see here is that while the goods trade balance will decreases well in the late 2010s, but this yellow point, the primary income, will start to increase. Well, actually, before the global financial crisis, well, primary income, which is kind of what the profit from what the income from their from over the productive well productive component in well drawn from the overseas, it was negative, but well it became positive after the global financial crisis, and well in the recent years, well in 2019 and 20, well the level of the primary income increased a lot. So it is somehow related to the increasing of well foreign direct well outbound foreign direct investment, and also the portfolio investment of the domestic people to foreign countries. So so external financial assets grows with well direct and portfolio investments. Well, on the left hand side, we have our external asset graph. So here, the green bar is the foreign reserve, right? So our reserve asset, and what you can see here is that there's the orange bar, which is the direct investment, and also the gray bar, which is portfolio investment, increases over time, especially during 2010s a lot. And on the right hand side, this is external liabilities, which means that this is a foreigners investment asset held. When you talk about when you see the difference between these two, which is usually called the net IIP, basically the left-hand side, the external asset is something, well, the domestic people has their asset on abroad, and this is kind of the asset from a national economist point of view, and the right-hand side, liability, is something kind of the other side. So this is the difference, and what you can see here is that, this orange line, the net IIP, becomes positive at 2014, and even without reserve asset, this net IIP becomes positive after 2018. So the Korea is now turning into a net foreign creditor and the things. And here, so what we have seen is that during the 2010s, there's a kind of some structural change, looks like, in Korean, the external sector of Korea. So what contributes to this change is that, first one is that I say is the China's growth during that point of time. Well, even though the China's high growth happens in 2000 or 2000 after it is entered into the global network, but during the 2010, it also shows the high growth, maintains a high growth rate, something like 7% per annum. But recently, it is declining. At the end of the 2010s, it's declining, and according to the IMF projections, it is declining. It will decline further. Here it is until 2018 and something like 3.5%. So it is converges to the world growth rate. So
well, yeah, there's things. And here, well, on the right-hand side, what you can see is that actually the, well, trade integration with, well, China increased a lot during the 2010. So the scale, where you start with from 2000 and 2005, 2010, and 15, and 16, 17, 18, like that. So at the 2010, well, the Korea's export share to China, well, Korea's export share to, Chinese share in Korea's export is 10.7% in 2010, while with the Hong Kong, it is, well, roughly about 17%. But, well, 2015, right, so it becomes, well, more than 31%. Well, Hong Kong and, well, China together. And 2018, at its highest, it is something like, well, 34% of the total Korea's export was taken by these two countries. And, well, roughly when you can see, well, here we have, say, Korea, China and Hong Kong, and the US and the EU and UK, and here, well, Vietnam. When you can see here, this, well, gray bar, the Vietnam share is increased a lot during, well, 2010. So, but, well, anyway, so, well, what you can see here is that in the long term, well, the China's, well, the Korea's exposure to China is, well, increases. So another part is that in 2010, well, basically the most important, well, industry in Korea now is the semiconductor industry, and well, semiconductor industry, well, there's some deepening, well, in terms of the technology and the market share. So, well, the left-hand side, you see, say, Korea's export by product. Okay, so export share by each industry. So what this gray area is the semiconductor share out of the total total Korea's export. And 2018, well, it is something like 21%. Well, and the well, this year, well, it shrinks to 15%. So this is, well, the nominal term. So it is not only, well, it also has an impact over the price effect, but somehow, anyway, so about around 20, more than 20% of semiconductor industry has been taken up the Korean export at some point, right? And on the right-hand side, well, we can look at, well, this semiconductor export by country. So here, this orange is China, and blue, deep blue is the Hong Kong. So compare this, well, the export to China and Hong Kong together, what takes about, well, say 2017 and 18, well, it is about 67%, somewhere like that. And recently, this share shrunk a little bit, and to about 55%, well, something like this. And, well, another part in well, that can explain the Korea's, well, growth in 2010 is that kind of stabilized oil prices during the 2010. Well, I mean, well, yeah, well, it is not low, but somehow the fluctuation is quite stabilized during the 2010, especially latter part of the 2010. And recently, well, it goes up again. But, and its impact, well, when you look at the impact on the import price, well, this blue line on the right, and then this, well, import price is also kind of stabilized with that. So, well, slow down of Korea. Well, this is the same graph that, well, Dr. Yoon showed in the first session, that, well, you can see that, well, China's growth forecast, well, has been a little bit, revised down from the KIEP's forecast from May forecast to November forecast. And here, well, so what is the problem here? So, well, basically, what people think is that, well, China couldn't really get back on track after the COVID-19 shock. So somehow, is there some structural change or in their growth, or, well, this is just a cyclical part of it? Well, it is still early to say, but well, it looks like there's some consensus, well, in the research institutions that, well, there is some kind of the structural slowdown in China's growth. Okay, So what happens in China? Well, there's several factors that affects the China's growth slowdown. So first one is that, well, even though it is, well, there has been some high growth over, well, quite a long time in Chinese economy, well, the productivity is still low compared to the advanced economy. So, well, the one means the US level, and the, well, when you look at this China's level, it is about 40%. Total factor productivity is about 40% of, well, low 40% of the US level, while the Japan and Korea is something around 70% of the US level. And another part is that, well, inequality issue there. So, well, during, say, late 2010s, right? So during, well, the people start to worry about this inequality issue, and then its bad impact on growth, long-term growth. And the, well, when you look at the Gini coefficient, well, China's Gini coefficient is quite, well, high, well, compared to other countries, is even higher than the USA. US. Well, it is even after, well, the Gini coefficient drops, well, a lot, well, during 2010, well, late 2010, well, it is still high. So another part is that what is happening is that, well, economy, Chinese government is trying to tackle these kind of problems. So, it shows, it tries to change its, well, growth model. So previously, the China uses the export-led growth, well, like what we did, well, in Korea, well, Korea did, well, previously, and also investment-led growth model. And they're somehow, after, well, thinking about some long-term problems, where they moved out of this, well, tried to move out of this, the previous growth policy to another part. So somehow recently, well, I mean, it is well happening in 2016, 17, and something like that. So well, dual circulation, well, in other words, the supply side reforms or strengthening consumers, well, something like, well, this kind of policy is, well, there's a policy changes in China. So on the left-hand side, you can see that the trade ratio to GDP dropped a lot. Well, and also the private consumption ratio to GDP will moderately increase. Okay, so that's one of the things. And also there's some problem with the real estate problems, where real estate developers' debt ratio has been increased a lot, well, after the global financial crisis. So somehow they introduced the, well, real estate regulation, so-called the 3 red lines, well, in 2020. So, well, another factor that, well, makes this, well, China's situation worse is that, well, U.S.-China tensions, right? So it is, well, during the Trump era, so it started from trade dispute, but somehow nowadays it is going to be more focused on the future growth technology, right? So, well, the cutting-edge technology, which may China want to focus more on with respect to the future growth. So as a result, when you see in the data is that, well, there's some kind of inbound investment, well, foreign investment shrinks. So the blue line on the left shows the inbound FDI to the China, and on the right hand side, there's a capital flows or outflows can be seen in the data here. So, and another big problem in China is that the debt problem. So, due to say COVID-19 responses, it is not just the China's the case, but the government debt increased a lot during that period, and the real estate downturn and local governments declining revenues, increasing financial costs. These added to increase the Chinese debt, national debt. So on the left hand side, China's national gross debt to GDP ratio is, well, it's even, well, still low, but it is increasing. But when you look at on the right-hand side, well, this is the IMF, well, the working paper, well, taken from the IMF working paper, that, but the official, when you look at the, say, local government debt, well, this, well, compared to the official level, there's well, some big numbers, well, that which is related to local government financial vehicle, well, like what it is. So, well, this is something what in a background we can, well, see how Korea is, well, developed during the 2010s and how it is linked to the Chinese economy and what is happening in the Chinese economy. And so we are trying to, well, quantify that effect using some empirical analysis. Well, here, well, it's unlike from the IMF's analysis, it's more model-based. Well, our analysis is more, well, the empirical basis. So we use the global vector autoregressive model. So this is a kind of a model that, well, VL model, which is build a network of countries using macroeconomic variables. So, so, well, each country is, well, driven by, well, its own, well, domestic variables and also the, well, shock, well, affected by the foreign variable. And these foreign variables are actually kind of a combination of other countries' macro variables, domestic variables, and the things. Okay, so, and this is useful for an analysis of the spillover effect. So, well, traditional trade models can be used, well, to see the spillover, but well, this is more static. So we are more trying to use more the data-driven approach. So there's some related literature with the GBL and the GBL's the application to the China slowdown here. So let me, well, briefly talk about the model a bit. So there's a, well, individual countries model, and after individual countries model is estimated, well, we collect all this result to make the global model and make it, well, and give us some shock to one country's variable, then how it is transmitted to other countries for the variable. Okay, so basically, the individual country model has, well, several parts. So this is the domestic variables, which is dependent on its own past variables, and also it is dependent on the, well, exogenous variable, right? So, well, from external sector. So one part is that, well, other countries, well, variable, and this is, well, something like global variables, so-called, like the oil prices or the commodity prices. And this foreign variable, y star, is a kind of, say, the weighted sum, weighted average of well, foreign domestic variable. So, for example, well, Korea, well, when you look at the Korea, y have, say, Korea's GDP, Korea's CPI, well, inflation, and, well, Korea's interest rate, and something like that, and which is, well, affected by, well, U.S., well, GDP, Japan GDP, and China GDP, and the things where we think about this external, well, foreign variables as our, well, think about, say, the making the weighted average of those variables, and, well, try to capture that impact on the domestic variable. After each country is, well, estimated, we make the global model, and it can be represented as this. Okay. So in our analysis, we, well, stick with the 4 countries. Well, especially, well, I mean, we can, well, do a little bit more countries, but somehow we find that, well, this specification works okay. So Korea, China, Japan, and US. And here, well, the data here employed is from 2005 to 2019. So we start from 2005, because basically, well, well, here, well, when you do this weighted average, we use the, well, trade weight, and they are somehow the quarterly trade weight of the China is available from 2005 in some sense, and year 2009, we tried not to go into a more detail, that into our, say, COVID-19 shocks, where we restrict our example in that way. And in the domestic, variable, GDP inflation, real exchange rate, and asset price, and short and long-term interest rate and trade volume included. And here, as a global variable, we use the oil prices. So this is the result from our estimations, or the impulse response function. So this is first thing is that first impulse response is that China's growth shock. So China's growth slowed down by say slowed down by 1 standard deviation. And the one you can see is that the blue China and the gray is Korea, and Japan and U.S. there. And what you can see here is that in terms of China's GDP shock, it has a more impact on Korea, compared to Japan and U.S. And here, real exchange rate increases after this slowdown shock, and you can also see you can see that here in this case China's response is more. China's yen depreciates most, and then follow Japanese yen and Korean won. And in terms of trade volume, right? And this is the volume rather than percentage deviations, or somehow the numbers are a bit I mean, the graphs looks a little bit weird, but somehow this is in terms of level. Okay, so because trade volume itself, the U.S. is big, so but anyway, so this is the result. And the asset price, the result is Korea is more exposed to this this shock. And another the impulse response scenario here is that we give a real estate shock to the Chinese real estate shock by -1 standard deviation, and you can basically see the similar result here, that in terms of the output, GDP, the Korea is most affected, other than the China, and their trade volume is also similar as in the compared to the previous the GDP shock, and real exchange rate is a little bit fluctuating here, so it looks a bit thing, but this is the thing. Okay, so given that, I will close my presentation using with some policy implication. So basically, from these changes, what we can see is that this is from Korea's point of view. This is China shock is not a good thing, right? So basically, it will have the worst, the bad impact on Korean economy in many of the cases, but somehow we can use this as some opportunity for external sector reform. So the things, right? So the more industries are exposed to fierce competition against China now, so especially in manufacturing sector, and maintaining stable goods trade surplus will become more difficult in the future. So while trying to maintain cutting edge in some industries, a strategy for primary income expansion should be prepared, and primary income from outbound investment helps stabilize the economic cycles. And due to change in population structure and national pension fund dynamics in Korea, so basically we have this only about 10 years of time windows that we can implement this kind of structural change in our external sector structural thing. And another part is that we need to prepare for the GB shocks in addition to the China's growth and real estate shocks. Sound preparation is needed for negative shocks from China, and some worst case scenario should be considered. And China's importance as a production partner declines, and the intensity of competition increases. So further diversification strategy should be sought, and international cooperation is a key ingredient for our successful transition. Thank you. This is
All right, thank you for your presentation, Dr. Han. And then we have 4 discussion. I think due to the time limit, each discussion should have 10 minutes for your presentation. Okay, the first, Dr. Jung Dae-hee, please.
Okay, thank you for having me. It's my pleasure to be here today. First, let me briefly summarize the content that has been presented by Dr. Redo. Especially, I'd like to focus on downside scenario because this is becoming more relevant these days. As I understand, this research aims to answer the question of what the economic impact of a de-risking strategy is. So as part of this de-risking strategy, they consider friendshoring and reshoring. Here, friendshoring is to increase in the proportion of friend-produced intermediate inputs, and reshoring is to increase in the proportion of domestically produced intermediate inputs. So using the IMF's global macro model, they find that friendshoring would reduce the global GDP by 1.8 percentage point. 1.8% for 15 years. And then the reshoring would reduce global GDP by 4.5%. So this means that the reshoring policy would do greater damage or harm on the global economy than friendshoring policy. I think this paper is quite timely and policy-oriented and especially very relevant to Asian countries as it examines the spillover effects of supply chain policies of major countries on Asian countries. So I would like to make 3 comments on this. So the first one is, I think, so the question is, how much does the de-risking policy mitigate vulnerability? So first, I think it would be more informative to take a look at the economic benefits as well as the costs. So here, I just put some of the remarks by U.S. Treasury Yellen and National Security Advisor Jake Sullivan. So they are pursuing a strategy called friendshoring that is aimed at mitigating vulnerabilities. They can lead to supply disruptions, or they are for de-risking and diversifying, not decoupling. They'll keep investing in their own capacities and secure resilient supply chains. So this means that the purpose of de-risking is actually mitigating the vulnerability. So we need to also think about the economic benefits of this de-risking strategy. So I think in terms of this, I think I find some relevant researches. So some of them find that in a hypothetical situation where there is no overseas supply chain, the GDP loss due to the, for example, pandemic shock is estimated to be to increase. Sorry, this should be decreased by about 30%. So we can reduce the impact of the shock by about 30%. And the other paper shows that it is an IMF paper, and greater diversification reduces GDP losses by almost half. This means about 50%. And the other paper shows that that's almost about 30%. But I need to also point out that the economic cost of this policy is far greater than the economic benefits, because usually the welfare losses is greater than this amount. So that's one point I would like to make. And the second one is, what shocks should we consider in supply chain vulnerability? in considering the economic effect of de-risking, I think we need to take more attention to the possibility of weaponizing interdependence. Here, what I mean by weaponized interdependence is this. So weaponized interdependence is defined as a condition under which an actor can exploit its position in a network to gain a bargaining advantage over others in the system. This is by Dresner 2021. So for example, we can take a look at the US dollar in international finance, or for example, the electronic design automation in semiconductor industry and so on. So this example shows that some countries have very asymmetric network power in some areas, and they can use this network power in some political strategies. So I think the current supply chain policies, they are very much related to weaponized interdependence. And so I think with regard to this, we need to think about the simulations. So for example, in weaponized interdependence scenario, major countries are expected to exert substantial and long-term impacts based on the asymmetry of production networks centered on advanced strategic industries. So in these scenarios, simulations based on persistent and interconnected large-scale shocks can be used to compare the effects of reshoring and friendshoring policies in reducing vulnerability. And the last point is about challenges of de-risking strategies so far. So in reality, de-risking policy has challenges, and I'd like to point out Korea's experiences. So we have this act on assistance to Korean offshore enterprises in repatriation enacted in 2013. This is so-called the U-turn company support program. This has been used to support reshoring firms, which is defined as firms reducing their overseas production and investing domestically. However, recent K-Day research shows that the reshoring companies have been found to be smaller and labor-intensive and less productive, lacking in overseas production experience, and have significantly lower employment effects of their domestic counterparts. So this means that the policy is likely to fall short of its original expectations, especially in job creations. Also, we observed that high domestic labor cost makes the reshoring policy to be less effective. And regarding the friendshoring policy, we've seen that the increasing comparative advantage of China in intermediate goods market, or in Asian countries, I think in all over the world, and suggests that intensified competition between Korea and China in intermediate goods market of third countries. For example, in the right-hand side, I show the China share in Vietnamese intermediate goods market, and recently it's growing faster than it's growing, while the Korea's intermediate share is decreasing. So. Considering this trend, I think it is necessary to further strengthen international cooperation for friendshoring policies to be more effective. This is all I have, and thank you very much for your attention.
Okay, thank you, Dr. Jung. Our next discussion is Kim Yong-gi of KIEP.
Thank you for inviting me. Thank you, Dr. Reeder and Dr. Han, for sharing your studies and insights. I'm Yong-gi Kim of the KIEP. Today, I would like to express my opinion on the result of upside and reshoring scenarios of the IMF report. This graph shows the trade between Korea and China in 2001 and 2021, categorized by end users. As of 2021, in Korea's export to China, intermediate goods account for about 80%, and consumer goods only 5%. In Korea's import from China, intermediate goods make up about 52% and primary product 27%. As we can see, the intermediate goods play a significantly high role in bilateral trade between Korea and China. Korea and China are interconnected through the global value chain. Korea's exports to China mainly rely on China's global export and Korea's foreign direct investment into China. Also, bilateral trade is closely related with the intra-firm transaction among Korean companies in Korea and in China. The intra-firm transaction accounts for approximately 27% of Korea's export to China and 45% of Korea's import from China. So trading patterns between two countries seem not to change so much, but the trade dynamics are undergoing structural changes. As China's red supply chain policy gains prominence and Chinese products become more competitive, Korean intermediate goods are gradually being replaced by Chinese counterparts. Furthermore, Korean investment in China is slowing down. The proportion of China in Korea's total investment is declining from 39.3% in 2005 to only 10% in 2022. China remains a crucial trading partner for Korea, but it changes from a mutually complementary partner to a global competitor. Therefore, the impact of China's economic recovery on Korean economy will vary depending on the growth factor of China. So for instance, if China's productivity increases through technological innovation, competition between two countries in the global market is likely to intensify. If China enhanced productivity through institutional reforms, an increase in Korean investment in China may lead to a positive effect. Given the lower proportion of consumer goods in Korea's export to China, the impact of China's expanded domestic consumption might be limited. So in my opinion, when interpreting the result of the upside scenario, it is essential to consider these aspects. Also, I would like, I'm wondering whether there is a possibility that the result of the reshoring scenario are somewhat overestimated because the model takes into account only the current domestic production capability. But as we know, many countries are increasing their intermediate production capability by providing incentives for foreign direct investment for reshoring. For example, the United States is actively seeking to attract production facilities from Korea and Taiwan to foster the semiconductor industry. Given the similarity to the current practice of sourcing intermediates from Korea and Taiwan, the term friendshoring might be more sensible. In this sense, I would like to introduce the preliminary results of the analysis of more plausible scenarios from the perspective of Korea. The analysis is conducted with the OECD metro model and GTAP database along with the OECD TIBA data. The reason that I chose the OECD metro model is that the model exploits the information of bilateral and sectoral trade by end users. The considered scenarios in our research is similar to the friendshoring of the IMF report. The scenarios assume reduction in the interdependence of the major interdependence of intermediate goods and capital goods between the major advanced countries and China to the level of 2002 from 2022 and 2017. 2022 represents the most recent available year, and 2017 is the year just before trade tensions between the United States and China began. This graph depicts the trend in the share of import in the electronics market between advanced countries and China. As seen, the share of advanced countries in the Chinese market is decreasing, while the Chinese share in advanced country market is increasing. So this trend is observed similarly in other industries. Fragmentation of the global supply chain has negative impact on both major advanced economies and China, while relatively positive impact are observed in regions such as India and ASEAN. For advanced countries, the negative impact increases proportionally with the dependency on China and trade openness. In this regard, Korea is most affected, and China also faces negative consequences as the demand for Chinese intermediate goods declines. This finding is quite similar to the IMF report, highlighting the need for policies to minimize the cost of reshaping the global supply chain and international cooperation, such as the IPEF. Thank you for your listening.
All right, thank you, Dr. Kim. And then next is Dr. Chris Ladle.
Thanks very much. So I'll provide some comments on the China shock and spillover effects on the Korean economy. There are brief comments. There's effectively three parts. So the first from Dr. An reviewed the external sector of Korea. I'll just focus on the trade elements, which are linked to our discussion about China. So there were three kind of broad highlights there. There's a sharp decline in the overall Korean trade balance, especially in 2022, and data up to October looks like the same thing will take place this year. Declining exports to China and Hong Kong are significant over the same period. And in terms of looking at decomposition of what's going on in trade, slowing semiconductor exports are a significant part of that, especially those via Hong Kong. A couple of quick remarks. So this nicely illustrates the degree to which Korea is heavily exposed to China spillovers. I had a couple of questions. Just the decline in exports seems much smaller than the decline in the trade balance. I was wondering if imports are playing a role here, and how much services exports to China might have picked up to offset some of this. A second issue was I wondered about the role of the global tech cycle in these effects. So you see a big effect in 2022, but we know that there's been this decline in exports for goods like semiconductors. How much of that is got to do with it, and how much of it is it a China story? On the growth slowdown in China, four elements were highlighted, which is very much in line with the discussion we have in the Rio on the chapter on medium-term growth slowdowns. So a slowdown in convergence with rich countries and a middle-income trap relating to low productivity and high inequality. The rotation of domestic demand in place of external, this has started to take place in China, but as was noted, this remains excess investment, in particular the real estate sector. Thirdly, fragmentation is likely going to be a drag on trade going forward, as well as a drag on FDI and other capital flows. Debt is an important issue in China, especially the element of local government debt, and we know that there is a feedback there with the property sector where sales of land are important financing sources for local governments. My remarks will just highlight the kind of elements that we have found in our analysis, which I think largely aligns with these points. So I mentioned in my presentation that the issue on convergence, that indeed China has experienced really exceptional growth relative to what you would expect given its level of development. But our projection is that there is going to be a significant drag on China's growth going forward. In line with these comments, demographics is another one that's obviously important, and productivity slowdowns are also significant. On fragmentation, indeed, we're fully in line with your concerns that this is a very important issue going forwards. Our de-risking scenario suggests that reshoring and friendshoring may contribute to significantly weaker growth in China in the medium term. Lastly, there's a quantitative analysis of spillovers from shocks in China using a global VAR model and some discussion of policies. So the model is a 4-country model with Japan, China, USA, and Korea. It's got a rich set of outcome variables and uses oil prices as a global variable. There's 2 shocks which are of current interest at the moment, which is GDP shocks in China, but then also shocks to the real estate sector. So just to note, this is quite different to the analysis that I presented earlier on medium-term scenarios. This is more about a short-term impact of a shock that happens today, whereas what the chapter I mentioned was more about a scenario where you have a long, slow decline in growth. In our previous regional economic outlook, we did actually present a box on exactly this topic. So I encourage you to check that and see what our results were. And we've also done a lot of work on this topic in the fund. So my remarks on that is just looking at the results. The large GDP spillovers to Korea make sense. They're very much in line with what we've all been discussing about these deep trade links in Korea. I think you highlighted as well some of the trade volume spillovers were a little bit surprising. So, the trade volume spillovers for the USA were very large in relative to Korea. And it suggests that the asset price channel was really key in the model. Whereas we know that the trade links are particularly important in between Korea and China, so that's maybe something to carry on working on. One thing I was wondering about is, the estimation period goes over the global financial crisis. That is going to be the largest shock in the sample. This is a financial shock and will, determine a lot of the co-movements between GDP in that period. So it would be important to avoid conflating those spillovers with China spillovers, because these are all going to be highly correlated and coordinated at that time. One thing that could be done is adding the asset price factors as controls in the final estimation equation. On the real estate shock, this is something of great interest to everyone. I mean, Tristan presented our results for this issue, but I was not 100% clear how it was defined. I assume it's the asset price shock in the model. The GDP effects for China seem pretty modest. I assume that's because this is a very, very volatile sector, but I wasn't 100% sure. But also, given the size of the real estate sector, one would expect a little bit bigger effects domestically than what we see. In terms of policies, I think we're very much in line. I mean, just highlighting what we talk about in our report, that fragmentation risks are significant. And in terms of policies, maintaining regional cooperation, including via multilateral institutions, will be important. Let me also add, avoiding regional trade agreements that implicitly include some fragmentation would be important to avoid, and supporting the full functioning of the World Trade Organization is also a helpful policy move to avoid some of those fragmentation risks. That's it. Thank you.
Okay. All right, thank you, Chris. And our last discussion is Professor Choi Sang-hyuk.
Sorry. Thank you for having me here. So I'm Sang-hyuk Choi from Yonsei University. So I'm particularly happy to be here and discuss this wonderful policy works, given the fact that I was sitting at the other side of the table 8 years ago, producing the input for the World Economic Outlook. So today, I'm going to focus on three aspects of the presentation by Dr. An. So it seems like the Korean economy has benefited a lot from rapid growth in the Chinese economy. So we know that this rapid growth, like spectacular growth by Chinese economy, really helped Korea to cope better with the global financial cycle and afterwards. So it is a blessing, but is it? So today I'm trying to be more balanced and think about my own interpretation of their own presentation and also the data that I have. So this rapid Chinese growth has been blessing for the Korean economy on the one hand, but on the other hand, it took away our own opportunity to do a lot of structural reforms. So in that sense, it could be disaster too. So anyway, so considering all the evidence that I have, it seems like those good days are really gone, and hopefully we can better prepare for the rainy days down the road. And I will conclude my presentation by providing my own thoughts on the global VAR analysis. All right, so here is so I'm trying to focus on stuff that are not particularly emphasized during the previous presentation. So this is the CPI inflation for China, right? So despite all this concern for inflation worldwide, the Chinese economy is actually experiencing the deflation. So, which implies there is a significant lack of domestic demand, right? But I don't want to be a Dr. Doom in this room, so I try to provide, some wishful interpretation of this same figure. So, in some sense, this deflationary or disinflationary environment of the China provides some room for a further monetary stimulus, which is not necessarily bad. Okay. So here's the consumer confidence of the Chinese economy. So as you see, it's plummeted from the level at the pandemic period. So it hasn't really bounced back, right? So together with the deflationary environment, this very pessimistic consumer confidence also reflects the domestic demand, especially from consumption, is unlikely to rebound in any near future. Okay. Relatedly, here is the graph for real housing price in China. So as you see, it's declined about 7% from the peak 2 years ago. So if you believe this so-called housing wealth consumption channel, it also adds some gloomy picture on the projection for Chinese consumption in the near future. And there is also huge heterogeneity across the regions. So this housing price or real estate price decline is more severe for some regions than others. Okay? It also adds to a concern about inequality. Okay, and local government debt was already discussed. So here is the level of general government debt for China. So when this graph was with Korea, US, and Japan, the level was relatively lower than those countries. But if we pick out individually, you see there has been a very fast growth in general government debt. So I had a chance to talk with very high-level policymakers in China recently, and their policy recommendation was more like, we all aware that local government debt is a problem, but there is a bright side because our central government debt is very low. So what they said is so-called debt swap. between central government and local government. Okay? So given the fact that the level of general government debt is still lower than other advanced countries, suggests it might be a viable option. But also at the same time, we have to really think about the moral hazard problem for this policy, right? So there might be not much cost in the very near term, but definitely it will bring about higher cost in the medium to long term, right? So lastly, we all know there is very large, high uncertainty about Chinese economic policy. And given the China-US relationship and upcoming US presidential election, it will probably add more uncertainty, not the resolution of the uncertainty, okay? So even though I tried to be more neutral, I can't help to say that good days seem to be gone, and we better prepare for rainy days. Okay. So here are my comments on GVAR analysis or my questions. So I tried to better understand this very nice analytical work. So they focused on only 4 countries because their higher trade share with Korea and their importance in the global economy. But to my understanding, one of the beauty of this model is to include more countries in a very flexible manner. And when it comes to trade linkages that they consider, European Union or ASEAN countries are actually way more important than Japan for the Korean economy. Okay, so I was thinking by missing them from the model, isn't there any missing information about the size of spillover effects? And also, they nicely presented the size of spillover effect from China to Korea and other countries, but it was a little bit difficult to understand the economic magnitude. So it would be great to show the same kind of exercise on the US economy and compare the relative magnitude of spillover from the US and from China. And they can also think about some alternative linkages other than this trade share. So to my understanding, they use bilateral trade weight between Korea and China, China and US, and so on and so forth. But to my understanding, today we spent a lot of time on discussing these global value chains, which is just more than a simple trade share between the countries. So they might want to consider some intermediate share or this forward and backward global value chain participation to better reflect increasing role of global value chain in international trade. Yeah, and also another suggestion for considering linkages other than trade, because I think Chris also brought up this question, but they looked at the spillover from real estate shocks. So naturally, what I thought is, why don't we consider financial linkage than trade linkage, because it has a first-order effect on financial shock from real estate sector. I understand it's way more tricky than trade linkage because there are a lot more to consider. So I've done my homework. So I went to the IMF CPIS data and found this share of portfolio investment between Korea and China. So the graph in the left side shows Chinese share in portfolio investment in Korea over the past 15 years. And the right-hand side shows Korean share in portfolio investment in China. And you see huge asymmetry, right? So Chinese investment in Korea has been relatively stable, around like 5%. But for Korea, we used to invest a lot in China, which includes Hong Kong and Macau, actually. But because of this diversification, our portfolio diversification, the share of Chinese investment it declined quite substantially. Okay? So still, given faster financial integration than trade integration over the past 3 decades, I think considering this financial linkage could be informative. And yes, lastly, I was trying to make sense of economic magnitude of these spillover effects. And indeed, I think Chris also pointed out this, but my interpretation was a bit different because I thought after one standard deviation growth shock to Chinese economy is followed by about 15% decline in trade volume from China, which kind of makes sense. But that's difficult to be reconciled with 0.03% GDP effect. So if it's 0.03% GDP decrease, then why do we care, right? So one standard GDP shock or output shock is actually huge, but spillover effect seems to be very limited. So I thought if this is just a matter of a unit, suggesting that it's not 0.03% but 3%, then I have to revise my assessment here. But then it becomes difficult to understand the unit on the decline in trade volume. So it would be beneficial to clarify the economic magnitude of the spillover effects. Okay, so that's all I have, and thank you very much for listening.
Okay, thank you, Professor Choi. We got a lot of comment and questions from the discussion. So this is what we deal with. First, I think we can give some time to the two presenters who can respond it from the discussion. After that, we will take questions or comment from the floor. And then they can actually ask response immediately after that. Okay, I think so. Please start with Dr. Chris Ledell for your responses.
Thanks very much. So thanks a lot to the discussants, very helpful comments. Let me start with Dr. John Dae-hee. So the first, you raised three kind of broad issues. The first was kind of the elephant in the room when we think about these fragmentation scenarios, which is the upside, like why are we doing these at all? Now that's often difficult to discuss in economic terms because sometimes these motivations are more political, and the way we approach and analyzing these is purely from an economic perspective. You did make a suggestion on how to think about it though, which is in economic terms, which is you're reducing your exposure to foreign shocks, which is a great suggestion, and it's not really the way we've approached it, but it potentially could be. So what we've looked at is, a kind of a move from one steady state to another, sort of a long-time scenario. But I guess one could add to that analysis, when you get to this other endpoint, you effectively have lower exposures to certain economies. And logically, you're going to have less spillovers from cyclical shocks at that point. So that's one way we could potentially quantify it. But in this work, we're really focused on kind of the medium-term analysis. But this is a nice point. In terms of weaponized independence, this is also a very nice idea, adding a kind of game theoretic element to the model where large players use their dominant role to extract benefits. This is nice, but simply was beyond the scope of what we were able to do in this time. So we added the GVC element to the model, which was part of something that was done for the World Economic Outlook. But I think going forward, this could be a very nice thing to do. But yeah, this simply wasn't within our resources at the time to extend it in that way. In terms of the third point, which is the challenges from de-risking strategies, so the sense that these would be positive for domestic economies. In terms of the way the model works, I mean, the results we presented were indeed negative over the horizon of the model. So that model would not support the suggestion that these de-risking scenarios would be positive to growth. Your point was more on employment, and employment in this model is a little bit different because it's very tightly linked to output. So although we didn't present it, it's very likely that employment would also be weaker if the level of GDP is also significantly weaker. On the point about increasing competition in third countries. So the idea that Korea and China would then compete more heavily in, for example, the market for intermediates in Vietnam, that actually should be part of our model in terms of these GVC links. It's not something we explored, but it's something that we actually could look at. I just think that it's a rich model and it's not something we paid a lot of attention to, but under the hood, this is actually something that should be there because all of these GVC producing countries are competing to provide inputs to other countries. And so it's under the hood, but it's not something that we highlighted. So again, it's just a very nice point and we'll go away and look at that. Just to the next, just a couple points on the next discussion. There was a point about FDI, that FDI for Korea has declined a lot. I think it's was also highlighted by Dr. Choi in the last presentation that there's been this sharp decline and the financial linkages maybe are of particular interest in addition to the trade linkages. And I guess, though Dr. Choi showed some more of the timeline on that, I guess the question is when that's happening. It looks like that decline, at least for portfolio investment for Korea, is happening on a sort of a different horizon to fragmentation and maybe is linked to something separate. I don't know enough to comment on it, but... and then finally, the comments on the strength of the shocks, particularly the reshoring in the model that we use. So I guess this will come down to differences between how those two models work, the GTAP model and the GIMF model that the IMF uses. So at least for friendshoring, these are not wildly out of line. But you know, there's some amplification mechanisms that model builds in. For example, these GVC chains. We have all sorts of other things in this model because it's used for a lot of macro analysis. You know, some households are constrained and are kind of hand-to-mouth consumers. They respond to shocks in a big way. This is a kind of an amplification mechanism that's in the model. And I'm not fully familiar with the GTAP model. I think this is probably a static trade model. Is that true? In which case, some of that amplification mechanisms might not be in place. But at least for friendshoring, these are not wildly out of line. I wasn't sure what horizon the drop was over. I don't know if this is a steady state change, in which case it's probably comparable to what we produced. Yeah, that's all in terms of responding to the discussions. Thanks a lot, very, very helpful, insightful
Thank you, Chris. Next, Dr. Han.
Okay, thank you for the interesting discussions from Dr. Riddle and Professor Choi. And let me start with the comment from Dr. Riddle. So, trade balance, and there's the graph on the trade balance and export, right? Export share of each country. And somehow what trade balance, recent dynamics in trade balance is also affected by the imports a lot. So basically the energy price actually, so Korea imports energy a lot. So that is also one major difference makes between these two. Another part is that you are talking about some tax cycle, right? So so when you look at this, the product share, so I mean in the export, and somehow there's two things can be actually seen in that graph. One is that this semiconductor share increases when the semiconductor price increases, international price of that increases, and also another part is that there's also some significant share. It's usually something like 13-14% of our export is related to petroleum and petrochemical product. So when the oil prices increases, that share also increases. So somehow, there's some, but usually for when you look at about last 10 years, this oil price cycles and the semiconductor price cycle is a little bit, not aligned together. So somehow, Korean economy in some part, the export is that at some part, the export is driven sometimes by the semiconductor, and some part was in some other years is driven by this petrochemical related the product. And about the
GVAL analysis, well, this real estate, well, when we have the asset prices in the model, so for other countries like the US and Korea and Japan, we actually use this the stock price index for that, and there for China, we use is the housing price index. So that's how we make this real estate shocks through that part. So I mean, we use the MSCI index for the stock price indexes for other countries, and there for China it is not available for those periods, or somehow we use that. So and your comment on when introducing controlling the GFC is good idea, but we also thought about that, but we haven't really find the way yet. Sorry, but we'll do that. We'll try to do that about it. And going to the Professor Chess comment, and I think, let me talk about the GVL analysis part. So why 4 countries? Well, we actually want to include the Vietnam in our analysis a lot, and this is the quarterly model, and somehow, we don't really, couldn't figure out how to. I mean, only annual series is available for Vietnam, so it is not really walking at in that direction. But somehow there's in the literature there's some analysis of some papers, and one paper is done with actually this World Bank paper uses Asian countries use GPA analysis on the Asian countries with the quarterly data. So I tried to find out how they did it, but I couldn't trace that down yet. So maybe if I found out, then we'll do that. And then in presenting the result, the impulse response, the size, your suggestion that comparing relative comparison to the U.S. shock, to impulse response to and the China shock, the result is a good idea that we may want to do. And as for the weighting, here we as you pointed out, we use the trade weight, and we also actually try to incorporate the this value trade the weight, so which is actually recently one of our staff in colleague in KIEP, he built up bilateral this value trade things from 65 to 2022. So we actually now is working on to put in our model, so that maybe it makes some more relevant than in today's things, but we haven't really got the result yet on that part. And the financial linkage is also, it could be interesting. There is something we'll try. Thank you.
If you got some questions or comment, we can have a question from the floor. No? Maybe we are almost 5 o'clock, so it's been a long time. If nobody has question, I will wrap up the second session of today's conference. Okay, please give all warm hands to all that discussion and presenter once again, and then we will congratulate you guys like this, and then that's it for the session 2. Thank you very much.